You can send an email around the globe in exactly 1 second, but sending money still takes 3 frustrating days. This delay is a byproduct of the correspondent banking model. Correspondent banking is a system where one financial institution provides services on behalf of another bank across different jurisdictions. Your money hops sequentially between multiple intermediary banks, slowing down and pausing at each institution along the way. This chain creates compounding problems. Agile fintech companies stepped into this void, offering modern speeds and stripping the cross-border narrative away from traditional banks. The G20 recently issued an international ultimatum through a set of strict performance targets. These mandates require a global overhaul to improve the cost, speed, and transparency of all international payments. Regulatory pressure and competition have made the era of slow, multi-day correspondent banking increasingly difficult to sustain. Traditional payment service providers, or PSPs, now face a choice. They must adopt new technological frameworks immediately or risk losing their dominance to tech startups permanently. The banking industry's response is the OCT Inst Scheme. This is a technical standard designed to rewrite the underlying rules of global money movement. The EBA, or Euro Banking Association, is an industry-led organization that manages large-scale payment systems in Europe. This document serves as the architectural blueprint for the banking counterattack. It mandates that transactions must process within 10 seconds, removing the multi-day delays of the past. The scheme also requires 24/7 processing, 365 days a year. This eliminates business days and holiday closures, ensuring global transfers continue through nights and weekends. These requirements remove global finance from its historical reliance on banking hours and geographic time zones. To achieve this speed, the system uses a bridge mechanism. This technical layer connects domestic payment systems directly to international corridors. This diagram illustrates how domestic instant payment networks, like SEPA in Europe, connect directly with global systems. SEPA, or the Single Euro Payments Area, is a framework that makes cross-border euro transfers as easy as domestic ones. Bridging these networks together bypasses the traditional intermediary bottlenecks. The blueprint also enforces a requirement for transparency. Senders lock in the exact final amounts and exchange rates before the payment is sent, which prevents unexpected deductions during the transfer. Removing the need for multiple intermediary banks causes the operational cost per transaction to drop. Banks no longer have to pay tolls to a series of middleman institutions. By isolating and removing these specific points of friction, legacy banks have engineered a global highway that aligns with the G20's requirements for a modern financial system. The world's largest financial institutions are coordinating a massive industry action to secure immediate global reach. This coalition includes heavyweights like JP Morgan, Deutsche Bank, BBVA, Citi, HSBC, and BNP Paribas. During a recent industry panel, experts including Alex Loydon and Mark Recker confirmed that this is an active strategy already being deployed, rather than a theoretical experiment. These institutions are now combining the speed of fintech software with the massive liquidity and established trust of the traditional banking world. As OCT Inst becomes the new benchmark for global transfers, the traditional correspondent banking model faces a terminal decline. For years, today, traditional megabanks are adopting those same agile capabilities to compete on the same playing field. Will these global banking titans use their new technological capabilities to reclaim the market share lost to fintech startups? Let us know in the comments if you think brands like Wise and Revolut can survive this shift, or if the big banks are finally moving too fast to be stopped. Subscribe for more deep dives into the changing world of finance.